Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, global markets reporter at Nasdaq. Joining us for this segment, we have Mark Hackett, Chief of Investment Research with Nationwide. Mark, it's great to have you with us. Welcome to Trade Talks.
Thank you. Interesting day for it.
It certainly is. Investors are creating two parallel worlds. What do you mean by that?
Yeah, we've seen through most of the post-pandemic, since the beginning of the pandemic, and certainly over the past couple months, equity markets have embedded fairly healthy expectations. We're sitting at about 21 times for the S&P 500. This is really the case even into last week, where the bond market has been much more skeptical. Rates have remained pretty low, below 150 for most of the summer, now below 140. It's not unusual to see a more skeptical bond market than equity market, but this is a little bit more bifurcated than we would normally see. The equity market's been a little bit disrupted the past week or so, but again, we don't see this as really endemic of anything really bigger than some disruption.
Right. So, Mark, as we get into 2022, what's your outlook for the equity market? I mean, it was quite strong up until the past volatility that we've seen in December. So as we look towards 2022, taking where valuation is and some of the macro issues that we're dealing with, do you think equities could have a type of year that 2021 saw, or a little bit more muted?
Yeah, we certainly can't think of the way that the last 3 years has been as the way looking forward. Their tailwinds are still behind the equity markets for no other reason than there aren't a lot of alternatives. But generally, demand is healthy, earnings are strong, and also flows from retail investors and share buybacks are certainly a tailwind for equities. But we want to tamp down some expectations of investors. We've been at 18% on average for the S&P 500 since the financial crisis, 20% for the past 3 years. If you look back to the kind of 2000 to 2010 period, we were actually negative on average for the S&P 500. We certainly see that as an anomaly, 2 recessions, 2 bear markets. But still, the expectation that we get another 20+% year next year, particularly given some of the headwinds that are developing with regards to earnings. So even if we have kind of a double-digit type of earnings environment next year, with the way the PEs are right now, it's not unreasonable at all to expect a mid-single-digit type of year for the S&P.
And to your point, you said, the bond market typically is a little bit more tempered than the equity market. Do you think that we could see a switch in favor in 2022?
Actually, I think the expectations of the bond market are probably even more out of whack. I mean, we saw an average of a 6% return for the past 3 years in the bond market, and despite the fact that interest rates are incredibly low. So if you have any movement higher in the bond market next year, the way that credit spreads are right now, it's not unreasonable at all to expect a flat to even down period for bond market over the next couple of years. Now, the caveat there is that assumes higher interest rates. And we as an industry have been pretty lousy, frankly, at predicting interest rates. So, if anything happens with regards to the Omicron having a more permanent type of impact in the economy, we could see bond yields actually come down. But the general consensus expectation is, modestly higher interest rates, perhaps flat to modestly wider credit spreads. That would obviously be a very difficult environment for traditional bond investments. We actually see investors probably looking for alternatives to traditional bonds, whether that be dividend-focused equities, derivative types of strategies, non-traditional bonds, anything that kind of get you a yield and a positive return in an environment that is very difficult for bonds.
Right. Let's talk about the economy for a moment. Has your view changed on the economic recovery with COVID-19 cases skyrocketing? We've seen some restrictions with professional sports, NCAA delays. We saw Davos got a delay announcement this Monday morning. Has anything changed in the near term? And then what about longer term? Because prior to that Friday after Thanksgiving, when we first started to hear about Omicron, things were kind of firing on all cylinders.
Yeah, Omicron is seriously something we're keeping an eye on, but we're certainly not panicking to at this point. Each of the developing variants that we've seen since the beginning of the pandemic has had a more modest impact on both demand, but also supply than the original component. So I guess we're kind of starting to learn to live with this, at least from a kind of economic and market perspective. Clearly, the personal human toll is something that is separate from that. But in terms of the market impact, we expect it to be fairly muted, which obviously is good news. Once you get past that, I think, as I said, if we can get to the point where we're starting to learn to live with these things, the Biden administration says that lockdowns are unlikely. So we're going to have pockets of disruption. You mentioned some sporting events. Certainly Europe has some incremental travel restrictions. But in general, we're at this point fairly optimistic that the large lockdown measure type of impacts are behind us.
Right. So with that said, do you think we'll actually get to rate hikes in 2022?
Well, being overly precise in terms of the bond market is something, as I mentioned earlier, is very difficult to do. So what we tend to do is look for how the market is looking for things relative to what the Fed is saying. We went into the last couple of months expecting, from a market perspective in the Fed funds futures curve, much more aggressive hikes than the dot plot was suggesting. The dot plot has actually caught up and surpassed at this point the market's expectation. So we think the market's skeptical that the Fed's going to make an error here in raising too aggressively too early, causing that to be flat and perhaps even cuts into the future. Obviously, the truth is probably somewhere in between. We're not saying the market is the best predictor in terms of what Fed policy will be. That being said, that's what we tend to look at because it's more instructive to look at where markets are versus trying to be exactly too precise for Fed rate hikes. That being said, our economics team does see hikes going forward. But again, being too precise in that world is probably a little bit optimistic.
All right. And Mark, to wrap up here, how could inflation and input costs impact earnings when companies start to report in the middle of January?
Yeah, we've actually been pretty happy with the way that, obviously we're seeing large pieces of inflation, but it's not really hitting earnings, particularly in the third quarter. Margins were almost near records, despite the fact that we had producer price inflation well in excess of consumer price inflation. So the way that management tones have been, the way that demand has been from consumers has actually been fairly optimistic to what we think we're going to see in the fourth quarter and even into 2022. That being said, it's a much different environment for earnings today than what we saw through most of 2021. We have not seen massive positive estimate revisions for the fourth quarter, and estimate revisions, while positive, haven't been dramatically so for 2022. So we're likely doing this transitioning from this period of hypergrowth with really excessive results relative to expectations to a more normal period. And frankly, after what we've seen in the last 18 months, we would kind of take normal.
All right, Mark, appreciate the insight. Thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.